off this presentation. I think what I'm going to say in this presentation, at least a half of you, maybe 2/3 of you already know. I know that some of you actually have quite some expertise in financial accounts, those online as well. You certainly know quite a lot about sector accounts, many of you. So even though the slides are relatively kind of basic, the idea is that it brings us all up to the same level. So those of you who already know this stuff, please not try to yawn too loudly, okay? But we will talk through as we go along some more detailed parts as well. So my job is the first half of the presentations this afternoon. Emmanuel will come on and talk about financial instruments and valuation and these things in a second. But I will try to place the financial accounts within the national accounts, within the sector accounts, and we can talk a bit about that. So first of all, if we think about the flows in our economy, obviously our national accounts, since they were created back in the 1930s and 1940s, are based on a very simple kind of thinking, economic thinking. And that is that we have something called production, and that production generates value added. So we are very clear that there is something called value added coming from production. And then that value added generates incomes. And those incomes can then be spent, so to generate consumption, or alternatively, they can be saved. So this is the very simple, high level, non-financial world in which we construct our accounts. And then, of course, the interesting part from the perspective of this course is what happens below saving. And where do we go in terms of changes in assets and liabilities? And here, as we've seen, we can have both non-financial assets, capital, and also financial assets. So let's just place ourselves in this tree. We're talking about the bottom right corner, but actually we should see it also in the context of all of the flows that leads down to that right-hand corner. And part of our job, or main part of our job, and we saw it this morning from the user needs, is that the users are not just interested in financial accounts, they want to link the financial accounts with the other things going on in the economy, and they want to understand why the financial accounts are changing in the way that they do. You know, what's working there? What are the main driving factors? And part of those driving factors are the real economy, and part of those driving factors are the financial system itself. So what we'll do is we'll have a quick look through. We also saw from the user needs, and you'll all be familiar with this nomenclature, that we have our non-financial accounts, we have our financial accounts, and these are in the form of flows. And then we have our balance sheets, and we can construct these accounts and balance sheets for the whole economy, for the rest of the world, for each of the sectors and subsectors. But I think here, the important part, and perhaps we can come on to this now, is the reconciliation of the stocks and flows. We know that users are interested not only in the transactions, but also and predominantly in the balance sheets and the ways in which balance sheets change. So Emmanuel mentioned a long-time IMF focus on the balance sheet approach. Really look at the balance sheets, look how they evolve over time, and explain how the balance sheets evolve over time. And of course, we can explain it by transactions, but we can explain it also by these revaluations. And we can explain it by the other changes in volume of assets, what we call the other economic flows. So you can take two balance sheets, and then quite often in our data sources, we just have balance sheet information. You know, for many places, you'll get balance sheets every year, or if you're lucky, every quarter. And then you have to work out how and why are they changing and fill in the gaps of the transactions and the other economic flows in between. Clearly, for financial accounts, revaluations or price changes are very important. But as Emmanuel will explain later, it depends how you value your financial instruments as well. But when you're looking at market values, clearly the price changes will be important. The asset values will change, and then you have these revaluations. And in my experience, users are really interested in separating what are transactions, what's being driven particularly by the real economy, and what is a price change in terms of the fluctuations of the financial markets. So separating them and presenting them well is really important. Okay, so what is an account? Well, I think it's fair to say that very few countries present their data as accounts to users, right? So we have our system of national accounts, and in Europe, we have our European system of accounts. And these accounts are actually, and I'll explain a bit what they look like. But in practice, when we publish our data, we don't publish them in the form of these accounts. We publish them in the form of the main indicators in a more matrix structure, okay? But here, I'd just like to talk about what accounts look like for those of you who are less familiar. So an account is basically, has two columns, we know, and it separates in the financial case, the assets from the liabilities. So we know that main principle in financial accounts. You do not net off assets and liabilities. So if an entity holds bonds as an asset and bonds as a liability, you don't just net them off, you keep them separate. And that's been a fundamental approach from the very start, because the users are interested in the assets and the liabilities. They want to see this split. The trouble is, in some of our data sources, we don't necessarily get this split so easily, but it is really important. The other thing about accounts in national accounts is that they have so-called balancing items. So you put things in your account, you know, pluses and minuses, and then at the bottom, you make your account balance. And that balancing item is actually important, and it's defined in such a way that it has meaning, it has economic meaning. And some great examples are here on the slides. We're well familiar with gross value added, or GDP, national income, GNI, saving, and net lending, net borrowing, which we will see later. And of course, the same types of transactions, as well as assets, can appear on both sides of our accounts. Banks in particular have very substantial flows of interest in and out. So once again, we should really be separating out those flows as well. So I'm hoping that all of you know this already, but anyway, it's just a quick recap. And indeed, following on from my arrows earlier on, we have the different accounts here. And even though they have these strange names, probably in your own national languages as well, actually, the main focus here is the story is going from production to income, to consumption, use of income, to capital, to financial. Okay, so you have this cascade of accounts, and that's a useful cascade. So let's focus on the capital account. Those of you familiar with your accounts will be looking at this one and saying, yep, I know this one. On the left is our assets, on the right are our liabilities. And we start off the account with saving. So that's the saving, which is generating the resources. And then we have a whole bunch of entries and exits. And at the bottom, we have our balancing item, which is net lending, net borrowing. So in this kind of account presentation, you see that we're going through all of the different items and ending up with a balance at the bottom. And if you can think about a financial account, don't worry about the F1, F2, F3. You probably know them already. Those are the financial instruments. Emmanuel will tell you more about them. But I think the fundamental part about this is, again, you have your assets and your liabilities. And again, you have a balancing item, net lending, net borrowing. But here, let's have a look at what I've entered into this table. Because what I've entered into this table is actually quite interesting. What's going on here? So here we see a plus 50. That is F2, which is currency and deposits, for example. And then we have more liabilities in F3, which are bonds. And then we have a balancing item of plus 20. So what is that telling us? It's telling us that or this entity for which this account was created has 30 more liabilities in bonds. So probably it has issued 30 in bonds, for example. It's got 30 in cash by selling those bonds. And then the other 20 of cash is coming from a non-financial something. Somewhere, this entity has found 20 more in cash, currency and deposits, okay? So when we look at the financial account, we're always thinking about there are two different kinds of impacts on the financial account. The first one is coming from the real economy, and that's the plus 20. That's what's coming from our consumption, our income, our production. And then there's something that goes on just within the financial accounts, and that is you are shuffling your assets and your liabilities. We could call it a portfolio effect, and you're simply taking more liabilities because you want more cash. You can imagine for households over time, what we see is households in terms of their assets, their investments. We can see that in some cases they will have more equity as assets and maybe less bonds, for example. All of that is within the financial account. It's not coming from the real economy. It's coming from within the financial part of the world. Okay, so I hope again that you know all of that. So that financial account had the balance between, and this is just repeating what I just said, that financial account had the balance between investment and liabilities being a B9F, or the net lending, net borrowing from the financial side. And of course, it should be equivalent to the non-financial net lending, net borrowing. Where it is not, we all agree that we call it statistical discrepancy. Everybody knows the lovely term statistical discrepancy, or the vertical balancing, as our colleague from Iceland mentioned earlier. He's got a challenge with that. And this is very much where you start to see the fact that you have different data sources within your accounts and you have a problem. So let's very simple example of a non-financial transaction. I go off and get a haircut. It's a bit of a joke, actually, but let's say that I go off and get a haircut, and the haircut cost me 15 euros. My consumption is 15 euros. Clearly, I have to pay for it. I'll pay for it, say, with cash or bank transfer or whatever. And I'm then having an impact on my financial assets, reducing them. So you can see this is just a symmetry, and we will have an exercise this afternoon just to warm you up on all of this as well. Okay. So let's talk a bit about institutional units, because within the SNA, within the ESA, it's very much the idea that we identify these units and then we put them into boxes. Okay. And there are two main kinds of boxes, two main kinds of classifications of these units in the national accounts. The first one, and the one we concentrate on, are the institutional sectors and subsectors. And the second, of course, are the industries, if you're doing an industry analysis. But we'll concentrate on the sectors. And here the idea is we're trying to identify these institutional units. We want them to be capable of owning assets, incurring liabilities on their own behalf, so they have some decision making. We have some very practical criteria, which are basically, do they have some autonomy of decision, or are they told exactly what to do by somebody else? We also have to be able to collect complete accounts, and we're dealing with residents as well. This idea of institutional units, of course, and we'll come back to this again during the course, is identifying these units. It can be sometimes be very challenging. You need registers of these units, and are the registers giving you good enough data on the units themselves and their relationships with each other? So a classic example is a large corporation which has many subsidiary companies. So you have this kind of structure where you have many entities that are related to one another, and you have to try and work out from which part of this entity will I be collecting information. And when I do collect information from that entity, how do the transactions and stocks within those units impact on my accounts? And I think it's very noticeable, and we'll deal with this when we talk about consolidation, whom to whom. You saw some data this morning. It's surprising how much non-financial corporations finance non-financial corporations. So you look at it and you think, non-financial corporations, okay, well, they must get all their financing from banks, right? Or issuing bonds on the market or whatever, right? But in fact, in practice, because of these relationships between these units within a company or across companies, you actually get a lot of financial action within multinational enterprises, or indeed within large companies at a national level. And so that's something I'm sure the course will touch upon in terms of the practicalities as well. So we saw all of these institutional sectors this morning. I think pretty much every presentation this morning was presenting the institutional sectors and the subsectors. And what we're doing is we're putting all of our units into one of these institutional sectors. But as I said earlier, depending on the amount of detail you have about your units, you may find that some units enter, for example, non-financial corporations, but they actually have quite substantial financial role. You may find within financial corporations that, in fact, one part of those financial corporations is just in the business of recycling money within a non-financial corporation context. So Gerard presented his numbers, and you start to see that holding companies start to become extremely important in some countries. So I think that's the important thing here, is these institutional sectors have a lot of crossover between them when you're putting the units into them. We can think a bit about consolidation as well. And that's always something that our users get very confused by. So when we're presenting data, the business of explaining to them what is consolidated and what is not consolidated becomes absolutely vital. And you saw that from the charts this morning. The majority of charts this morning were non-consolidated, I guess, or the data that was presented was non-consolidated, right? So basically, do we all have an understanding of what consolidation means? Consolidation is eliminating the intraflows within the same sector. So simple example, you have Bank A lends 50 to a household and 30 to Bank B, and Bank B lends 20 to a household. If you simply add up the total lending, you would get everything added up would be 100, yeah? But of course, you don't want to include the 30, which has gone between Bank A and Bank B, if you want to consolidate. And that's the difficulty that a lot of our users have, is that some of our users want everything. They want to know how banks are interacting with each other. They want to know the total level of credit in the economy, and they want to see, you know, what are banks doing with each other. And that's commonly the central bank's position. That's what the central bank will be predominantly interested in, really. Whereas you talk to fiscal experts, people using government data, they don't want non-consolidated government data. They want consolidated government data. They want to remove all of these intraflows within government because they want to see government as a whole vis-a-vis the other parts of the economy. And therefore, for example, government debt would be on a consolidated basis. We don't mind that different parts of government hold some government bonds, you know, that's quite common. But we don't care too much. What we care about is how many government bonds are out there outside government. So this process of consolidation, and I'm sure there will be much discussion on the practical consequences of consolidation, is really important. But of course, the challenges are huge as well. You need to know the counterparties everywhere in order to do that. And moving on to the whom-to-whom analysis. Just on a point of English language, some people call it who to whom, and some people call it whom to whom. Whom to whom is comes from the days when gentlemen fought duels with swords, right? But it's still the term that we use. So this whom to whom analysis is about extending the accounts, and in fact, it is extremely rare that you will find any set of financial accounts now being published without some whom to whom information, because the users absolutely demand it. And what we're doing is looking at these counterparties. Now, one way to do it is in a matrix form. So the matrix form would look a bit, oops, sorry, I don't have it. One would be in a matrix form, and we saw that from Pierre, the ECB presentation this morning. So you say, who is investing and who is financing? So you get this big table with a matrix, yeah? But one other way to present it is what we call a flow of funds statement. And in your introductions, I heard at least 2 or 3 people mention flow of funds. So the idea of the flow of funds is that you bring everything together. You bring together not just the financial information, but some non-financial information as well, capital, investment, together with this whom to whom, so that you get a full picture of what's going on and what's driving finance in the economy. So a good example actually of a whom to whom, which is extremely common, you see it everywhere, even if people do not construct the full matrix of who to whom. What they do is they, for example, will break out who's holding government bonds. Because government actually would like to have a pretty good idea overall of where are its bonds. Are they held by residents or are they held by non-residents, for example? So you see parts of this whom to whom in pretty much everybody's accounts, even if they don't construct the full matrix. And I think that's one of the aspects that was mentioned this morning, which is these steps, these baby steps towards making financial accounts. Sometimes you start to produce some of these information on counterparties, and then you start to produce more as your data sources improve, and you start to fill out the matrix of whom to whom. And indeed, though, as I pointed out earlier, the source data requirements can be extremely heavy. Now, that's my presentation, right? It was very simple. You should know all of it anyway, but I think the important thing is to start us thinking about where the financial accounts lie, and we start from the same position in terms of understanding. So thank you very much. Over to you, Gerard.
Thank you, John. And even though it might be very clear, I can imagine there might be some questions for you.
Gentleman at the back.
Yes, please. Yeah, you can go.
Thank you for presentation. My question is, when there is a disbalance between financial accounts and non-financial, I mean capital accounts, and the discrepancy, I mean the difference is very big. So what shall be done to bring it closer, the net lending and net borrowing?
First of all, you would not be alone in having statistics. Everybody has statistical discrepancies. If you ever meet a statistician who says that they don't have a discrepancy, don't believe them. Okay. The second thing and the principle is some statistical offices try to hide the discrepancies by simply adjusting one of the financial instruments quite commonly. And that is something that we do not recommend at all. So I think it's better, you do a better service to your users by showing the discrepancy and explaining a bit to your users where it comes from, at least in general terms, and try to give them some advice, perhaps on where the weaker areas of the accounts are. But don't hide it. Don't just adjust it away and it just disappears. Okay. In terms of we probably go in the course in more detail about discrepancies. I think on the third day, is it that there's something on balance? Is it balancing? Yeah. So that'll be covered in more detail. But in my experience with countries that we've been talking to, there's a kind of a chain of things that you can look at. First of all, of course, where is the discrepancy in terms of sectors? Okay, because you can analyze your statistical discrepancy by sector. And you should find normally that the government sector has a much smaller statistical discrepancy than the others. That's quite common. Okay. If you find, for example, the government has a very big discrepancy, then that's probably the first place to start looking, because you're more likely to track down the problems there, because maybe you have access to administrative contacts who can sort it out for you. In theory, all of the data should be coming from one place. Then, of course, there's the registers. And actually, sometimes we see statistical discrepancies there because different registers are being used for the non-financial accounts and for the financial accounts. This can happen when you have two institutions working on the different parts: statistical office, non-financial, central bank, financial. That can happen. But as was said earlier, and will be said throughout the course, with some cooperation and coordination between the institutions, you can minimize the discrepancy coming from the register question. So if the statistical office is including within its register a whole bunch of institutions that the central bank is not surveying or covering, that immediately will give you a discrepancy. The other aspect of the discrepancy, of course, might be that you have your data sources in a different valuation. So some countries have found that actually when they look more closely into their non-financial accounts, they realize that they're not using market prices or market transactions everywhere. And that can also give you a problem. And then I'm sure on day 3, you will go through all the possible reasons for that discrepancy. But you will unfortunately never manage to eliminate it. But there are quite some success stories of actually narrowing it. And the other aspect, maybe more interesting aspect to think about as well, is that some of the biggest discrepancies often come in quarterly data. Maybe you're only doing annual data, but some of the really scary numbers for discrepancies you often find in your quarterly data. And that indicates that there's a timing problem. It's not just that you don't have complete data sources, but also there can be a timing problem that some transactions are being included in different quarters. But actually, the only reassuring part of that is over the annual data, these pretty large quarterly discrepancies actually normally are smaller. So if you're doing quarterly data and you see these large discrepancies over the year, they tend to a little bit get smaller. So yeah, that's what I can say for now. I don't want to preempt the discussion on day 3.
Okay.
Please, sir.
Thank you very much for such an interesting presentation. I have the question to the slide number 12 on consolidation. Why do you have that sum that is consolidated that is 50, not 70? Because both banks were borrowing to the households, right? So logically, the household was supposed to get 70, but not 50. Slide number 12. Do you see
Okay,
that?
I'll have a look at the slide. Maybe I put the wrong number in quickly. I think the point of the slide, you're probably right, but I think the point of the slide was to show that for a certain kind of user, the interesting part is what is going outside of the banking sector. So what is going to the households, and the less interesting part will be what the banks are doing themselves. So for one kinds of type of users, it's fine. Well, for one kinds of users, you will want to see what's happening outside of the banking system, the relationship with the households, as you rightly said, probably at 70 instead of 50. But actually, for other kinds of users, they want to know about the 30 inside the banking system. So the fundamental part about this is what's going outside the banking system is the consolidated number. And what is going on within the banking system is the amount which is interesting for some users. That is, how are banks interacting with each other, but is less interesting for those who just want to focus on households. So you're probably right here. What did I do? Yes, I'm sorry. It should be 70. You're absolutely right. Silly me. Okay. Anyway, but that's absolutely correct. Please, question over there.
I just was interested in disbalances, which was discussed between non-financial accounts and financial accounts. And especially I'm interested if there were any anchor indicators, target indicators, for example, how large these discrepancies should be treated as a normal one. For example, I don't know, these discrepancies to GDP or other indicators.
Yeah, it's a good question. In fact, within Europe, Eurostat and the ECB has been running a task force looking exactly on vertical discrepancies. And this was the question. What kind of benchmark should we set ourselves for what's acceptable or not acceptable? And that comes into two parts. There's the absolute size, but there's also the pattern as well. So you have to think about both. How big are they and how volatile are they? And I think that on the size, from memory, I can't remember, but I can look it up. It was pretty big percentages for non-financial corporations and for households. I think there is this idea that for non-financial corporations and households, it's a much harder task to deal with it. And therefore, you should tolerate larger margins for it. For government, it should be relatively small and with no bias. So our government finance statistics colleagues will tell you that anything more than, say, 1% of GDP in terms of a discrepancy would not really be acceptable. Okay. And I think that's an important policy aspect as well, because, of course, you know that within the EU, this government deficit is a very big thing, and even outside, as our colleague reminded us this morning. And so it's clear that the government deficit is measured from the non-financial side. This is the data that go into all of the fiscal monitoring and so on. And that if you look from the financial side, you see a different number. So indeed, you focus on the non-financial side. That's where you explain in terms of expenditure and revenues. But then, of course, what we want to avoid is that from the financial side, you have a different kind of deficit and people say, well, actually, this is a better one. The finance minister asks you, you've got two numbers, which is the lowest one? And can I pick that one? You know? And I think that's the idea where you must have consistency, that you always take the number from one side of the accounts, and then you investigate and reduce over time and explain the discrepancy that you have. Yep. Anybody else? Yeah, please.
My question will be a simple technical question. I am mostly interested, when do we have minuses in assets and liabilities of financial account? Because this is this matrix, to whom, because sometimes we see these indicators with minus. How do you interpret that minuses and how do you come to that minuses?
Thank you. Well, the minuses in terms of transactions and revaluations and other changes are perfectly normal, of course. We would expect to see both pluses and minuses because we've separated the assets from the liabilities. So assets can go up and go down, liabilities can go up and go down. So in terms of transactions, we would expect to see pluses and minuses around. Revaluations, prices can go up or down. The stock market goes up, then it goes down, and you would have positive and negative figures. So for the flows, positive and negative figures are perfectly normal and fine. The more interesting question would be, what about the stocks? Do you ever see negative stocks? First of all, you should not see them very often. And secondly, where they do occur, often it is financial derivatives. It's often in the case of financial derivatives. And here, different statistical offices or central banks have different practices about what they do, because clearly financial derivatives can flip over. So they can have positive value, but they can also have negative value. People don't realize that if you buy a financial derivative, you may have to pay more than you paid for the derivative itself. Okay, it's like a bet. So in this case, what happens if the derivative position shifts and flips in the opposite direction? Then an institutional unit could have a negative position in financial derivatives. And you have two choices. Either you leave the financial derivative on the side that it started. So you bought it as an asset. It has a negative value now, and you leave it on the asset side. And then you have a negative asset, right? That's one possibility. Another possibility is you say, well, hold on a minute. As soon as that derivative gets a negative value, I'm going to move it to the liability side. So it's no longer an asset. It's a liability, and it has a positive liability value. And in this case, you have no negatives anywhere in your accounts. So there are two ways of doing it. Now, probably during this course, financial derivatives will come up several times as being a very challenging area of financial accounts. But again, the presentation is important for users. If you do have derivatives, and they are quite volatile, then if you have negative numbers, you have to explain what they are. That's it.
Спасибо.
Thank you very much.
Okay, thank you very much, John. Then we move over to Emmanuel, who will take us into the final instruments and the valuation.
All right, so good afternoon, everyone. So similar to John, this presentation here is more of a broad overview, of the financial instruments. And again, even for the valuation, it's going to be a broad overview. We don't have sufficient enough time to go through each of the instruments in detail, etc. So if you have any questions, of course, we'll pick up those questions. And if we don't have time, please, you can write them down and, you can send them to, and then we'll try to address them at a later time. All right. So in terms of the outline, I want to just quickly touch upon economic assets. And I know you probably already know the definition of economic assets. Then we'll go into financial assets and instruments. I want to talk briefly about a couple of special cases, and then valuation. And then I threw this in as other changes in asset account. And what I wanted to show here is that in some cases, you might not have, transaction data. But at the same time, when you have, an opening and closing balance, you can't just take the difference and assume that it's either a transaction or it's another change in asset account. So I was going to try to go through an example to show you what you could do to try to estimate, whether it's an economic transaction or whether it's another flow. But if we don't have time, you have the slides and you can, go through the example at your own time. And if you have any questions, you can please raise them. So economic assets. Just quickly, this is the standard definition that you're going to find in the National Accounts Manual, the SNA. So economic assets are resources over which ownership rights are enforced and are a store of value, right? From which future economic benefits may flow to the owner. And what are the types of benefits that are going to flow to the owner? Well, these assets can be used repeatedly, in the production process, okay, to generate, surplus for their owners. And the assets we're thinking about here are buildings, machinery, etc. And they also generate property income. They could generate property income, interest, dividends, or rent. And they also have the potential, for future realized capital gain. Okay. And assets, there's two categories of economic assets: non-financial and financial. Just so very, very quickly, when it comes to non-financial assets, what I tried to show here in this slide is, starting on the left-hand side, you can see the type of non-financial assets. Your gross capital formation going all the way down, to net lending, net borrowing. And non-financial assets also have to be broken down between revaluations and other volume changes. So there are other changes in asset accounts that have to be attributed to non-financial assets. Okay, and that's what we're showing here on the top right-hand side corner. Okay? So very, very quickly, what would be a volume change for a non-financial asset? Well, if you have a natural disaster, a tornado or a hurricane, for example, and it destroys part of your capital stock, that destruction has to be recorded as part of the volume change. Okay. Similarly, revaluations are very, very important when it comes to non-financial assets, especially for the household sector. So as John mentioned, revaluations are price changes. They're not transactions, but they result because of changes in prices, okay, which to go up or down. So when you think about households, and when you think about their dwellings, house prices go up, hopefully, or they go down. And when house prices go up, people feel happier, they feel richer, and they spend more. And when they spend more, that means consumption increases, gross domestic product increases. Okay, so you can see that with these price evaluations, there's a wealth effect that we can look at and try to analyze when we look at revaluations. And of course, we haven't shown here, but the balance sheet is basically looking at the opening balance. You have your economic transactions, other flows, closing balance. So it's a stock flow stock. Now, looking at financial assets are different than non-financial assets in one very, very important perspective. A financial asset, there's a counterparty liability. So there's a claim on another party. And that distinguishes financial assets from non-financial assets. Without that counterpart liability, in most of the cases, with a couple exceptions that we'll talk about now, they are basically financial. Okay. So what does that mean? That there has to be a counterparty liability, right? So if all financial assets must have a counterpart liability, we can say then that financial assets do not generate economic growth, right? Because at the end, when you put together your balance sheet, all financial assets are offset by all financial liabilities. So they don't contribute to wealth. It's a zero-sum game. However, as you know, in the system of national accounts, there are exceptions. So there is exceptions to this golden rule, which will add to global worth. One of the exceptions is monetary gold. Okay? So usually gold should be treated like other commodities, silver, etc. But in the case of monetary gold, because of its historical, historical function, as a means to basically, pay international payments, is part of the financial assets. And it's a financial asset without a counterparty liability. Okay. Some other exceptions by convention, we just mentioned monetary gold, is also special drawing rights. Okay. And in some cases, well, here, I guess it's debatable whether we should say shares have a counterparty liability or they don't have a counterparty liability. In this slide here, I'm saying that shares which do not impart predetermined claims on corporations are going to be an exception. But when you look at accounting, corporation accounting, equity is never treated as a liability, right? So the famous equation is assets minus liability equals net worth, and net worth is basically equity plus the accumulation of retained earnings. Right? Right. So what is a financial instrument? A financial instrument comprises the full range of financial contracts made among institutional units. And financial instruments are classified as financial assets or as other financial instruments. Okay. Again, other financial instruments. Now, besides financial assets, there are other financial instruments which are contingent asset and liabilities. Contingent assets and contingent liabilities are contractual financial arrangements between institutional units. And they involve a contract. And the contract is going to state that one party is obliged to provide something in the future only if certain conditions prevail. Right? So because those conditions have not materialized, they're not treated as financial assets in the system of national accounts. Okay. So some types of contingent assets and contingent liabilities, they include, one-off guaranteed payments, loan commitments, letters of credit, lines of credit, and some notes, underwriting notes. Okay. So in the system of national accounts, it's prescribed that we have 8 financial instruments, if you like. And the financial instrument should have the same classification in the accounts of the creditor and the debtor. So here what we're showing, if you look at the financial assets, what will be their corresponding financial liabilities? And here we're seeing what type of instrument. So when we look at, for example, monetary gold and SDR, the liability is SDR. Because as was mentioned, There's no financial liability for monetary gold. Okay? Now, I'm not going to go through all the 8, given time constraints, but I just want to look at maybe 2 broad categories of instruments, looking at equity and investment fund shares, and then we'll talk a little bit about debt instruments, and then we'll go into the special cases. So when we're talking about equity, equity is a residual claim on the value of assets rather than a principal and interest type claim. Right? It's not like a bond, right? A bond, there has to be some principal repayments sometime in the future, and it also could be interest accruing to that bond, right? Now, equity is treated as a liability of the issuing corporation or other unit in the national accounts. So in the national accounts, you're going to have, you're going to treat equity as a financial liability. And the reason why we do that is because on the counterpart, there is someone who holds that equity, shareholders, right? So in order to make sure, and you're going to see on the last day, one of the identities, that we'll be looking at is that for each instrument, the financial asset must equal the financial liability, going back to the first point that I just made. Okay, so that's why we treat equity as a liability, even though in accounting, corporate accounting, that's not the case. Right? And we also have equity securities, and they comprise of listed shares and unlisted shares. And you all know listed shares are those that are listed on an exchange, on a stock exchange. Unlisted shares, sometimes are referred to as private equity. Right? So private corporations have equity, but it's just not available to the general public. Okay. And then we have another classification within equity called other equity. Right? Now, with other equity, it's not going to be part of portfolio investment. And here, there's a mistake on my slide, and it may not be part of direct investment. It could be. Okay? So what is other equity? With other equity, we can't really differentiate the return to capital or the return on labor. We just have one, estimate for the net worth, the residual net worth left to the corporations. So it's the assets minus the liabilities. And we'll talk a little bit about how you can actually try to put a market value on unlisted shares and other equity. Okay. And then finally, we have investment funds. And investment funds are a collective, they're basically from collective investment schemes. And what happens is that they pool, shareholders' funds, for investment purposes. Okay. And when it comes to investment funds, they can invest in other financial assets, or they can invest in non-financial assets. Okay. Like apartment buildings, supermarkets, etc., and residential houses. Now, looking at debt instruments. So debt instruments are those instruments that require the payment of principal and/or interest at some point in the future. And when we look at debt instruments, some of the debt instruments are special drawing rights, currency and deposits, as mentioned earlier, debt securities, loans, insurance, technical reserves, and provision for calls, and other accounts receivable and payable. So this is the instrument classification. But now it's important, for your economies, this is what we want as basically the minimum for international comparisons. However, for your own needs or for your own policymakers, within these instruments, you could have subcategories, which will be very, very important, for your economy. Okay. So, for example, under loans, you might want to also have mortgages, or you might also want to put in maybe credit card debt, etc. As part of the G20 second set of recommendations, in addition to these 8 instruments, for loans. And for loans, we also want to know whether they're short-term or long-term, maturity. And we also need a currency breakdown, whether they're foreign currency or domestic currency. And one thing I want to just mention now, and I know for some of you, you're going to be just starting out building these accounts. Some of you are a little bit more advanced. One thing I really strongly urge you not to do, if you don't know the instrument, don't just plug it into other accounts. Other accounts receivable and payable have a specific purpose. Right? Other accounts receivable and payable include trade credits and other specific items that are not classified in the other 7. Okay? It should not be used as a residual category. Right? Because if you want a lot of questions, then make sure that you have a sizable other accounts receivable and payable. Right? Because unfortunately, you're not giving any information to users if you group everything under that account. Okay. And you got to be very, very careful because, when stakeholders and others are looking at, let's say, for example, credit and credit vulnerabilities, not all other accounts receivable and payable are interest bearing. Okay. Right. So now let's look at a couple of special cases. So one of the special cases that I want to look at is provisions. So according to the System of National Account, charges of loan losses to the outstanding loan balances are not transactions and should therefore not be included in the core accounts. Okay. So what happens with provisions? Usually financial institutions are basically going to decide unilaterally that a certain amount of debt outstanding is not collectible. Okay. So they're going to take a provision and, to basically exclude that as part of their assets. Okay. However, it's just a provision. Okay. The actual write-down has not occurred yet. It's just basically, with tax legislation, companies, even non-financial companies, are allowed to take certain provisions. Right? It's an assumption that they're saying that these things are not going to be collected. So what happens is that when they're going to provide you the estimates, right, loan loss provisions have already been taken into account. So when you look at the balances, they've been netted by loan loss provisions. Okay. So in the example here, we're saying that if the loan balance at the beginning of the period was 1,000 units and the closing balance was 1,200 units, and we know there has been a charge of 50, as a provision, some kind of uncollectible. Okay. What you're going to have to do now what will be the transaction? So you have your opening balance of 1,000, you have a closing balance of 1,200. So you can't take the difference and say the transaction is 200. Because this loan that was provided to you has been net of provisions. So what you have to do is you have to add back the provision. So the closing balance would be 1,250, not 1,200. And then your transaction is going to be 250. Now, when there is an actual write-off, when they're going to say, no, it's being written off, then what happens is that, again, it's not going to be an economic transaction, but it's going to be recorded in your other flows. Okay? And is it going to be recorded as a revaluation, or is it going to be recorded as a volume change? What do people think? Hands up for revaluation. Hands up for volume change. You got to decide one or the other. One more time. The write down, is it going to be treated as a revaluation? volume change. Volume change, right? And why is it a volume change? Did it have to do anything with prices or with a change in interest rates? No. Right? Now, just really, really quickly, if there was some kind of mutual agreement that yes, there's some kind of forgiveness, then it will not be shown as a volume change. Okay? When there's a mutual agreement to write down the loan or to forgive the indebtedness, then it's not going to be treated as, a volume change. It's going to go above the line and it's going to be treated as a transfer. Okay? And depending on what's being forgiven, well, most of the time it's going to be a capital transfer. All right. Now, one of the things that I wanted to quickly touch upon are financial leases. So one thing we haven't mentioned, but I know you all know, in the system of national accounts, ownership is determined by whom is the economic owner, who is going to benefit from this asset. In a lot of cases, we'll see 90% of the time or more, the legal owner and the economic owner are one and the same. So it doesn't pose any problems, right? Once we know who the owner is, who's going to be receiving the benefits, and who's going to have to incur any liabilities, we can assign it to the proper institutional sector. However, when it comes to leases, the legal owner and the economic owner could be different. And we have two types of leases. We have one which we call operating lease. And then with an operating lease, the lessor, person who has the asset, retains ownership of the asset. And what he does is that he allows the other institutional unit to use that asset, but basically it's a rental type of arrangement. So you're allowed to use the asset, however, the other person does not take ownership. So the economic benefits and the liabilities still rest with the legal owner. So that's called an operating lease. And here, what we're going to do is we're going to show, some the property income we're going to show is probably rental income. But there's other cases, with financial leases, where the economic benefits are transferred to the institutional unit that's going to use that asset. Okay. And then what happens is that the lessee, the person who gets that, is going to show that as part of their gross capital formation. And the lessor now is going to have a financial claim on the lessee, right? So he's going to be showing some kind of financial asset. And the lessee is going to show a financial liability, plus he also has, the non-financial asset. So in the past, prior to, certain accounting changes, that type of relationship was identifiable. And we were able to, no, I wouldn't say it was identifiable, but I would say that from the lessor's point of view, I think it was always identifiable. From the lessee's point of view, in this national accounts, we always had to make certain assumptions and adjustments. So for example, when you looked at car leases, in North America, no matter what you say, car companies are going to say no, until you make that final payment, that car belongs to them. That's it. And that's the way they record, the transactions in their books, right? Even though the lessee basically is getting all the benefits, that's the way they want to treat it. But now with the changes in IFRS, the distinction is becoming very, very blurred from the lessee perspective. It's very difficult for us to differentiate now whether the asset that the lessee has is actually going to be used, or it's actually he's going to have to be making rental payments, or actually there's going to be some kind of financial liability. Okay? And it's just the way they're basically asking companies to report it, as you can see here, is now under the new rules. What we're seeing is that they have a right of use of asset. So we can't differentiate now, where is this gross capital formation? Because from the lesser perspective, nothing has changed. But from the lessee perspective, we don't know whether now this capital is actually part of a rental arrangement or part of, some kind of a financial arrangement. And here, the compiler is going to have to do some more investigation to try to determine, how you're going to classify, whether it's being, financial or non-financial. So in the question, that was asked before to John, you have these discrepancies. This could be now one of the discrepancies that you're having, depending on how these things are going to be treated, by the lessor and by the lessee, and whether you're going to get, consistency between the lessor and the lessee. Now, I'd like to briefly talk a little bit about, valuation. And here I say market value, and John mentioned it mentioned as well, is the preferred valuation method in the system of national accounts. Okay. So the comparison now between, market value, nominal value, and you're going to see in the example face value. So there's many options of how we can actually, record transactions, or how transactions are being recorded. But in the national accounts, we specify that we want market values. So at any specific point in time, the market value of financial instrument may deviate from its nominal value. And as John mentioned, it's due to revaluations, arising from market price changes. Okay? As he mentioned before, stock markets go up, stock markets go down, interest rates go up, interest rates go down. And these changes in the price are going to cause revaluations. But we want to measure at market prices. We're not going to treat them as transactions, but at the end, we want the balance sheet to represent market values. Okay. Now, for debt securities, the market value is actually the nominal value plus the cumulative revaluations arising from market price changes. So let's have an example. It's really clear. So in this example here, we assume that there's a government bond, it's issued for 2 years, and it has a face value of 100. And the bond is issued at a discount of 30. Now, the face value, that 100, is going to stay 100 over the period, over the life of the bond. So over the 2 years, when we want to know what is the face value of this bond, the face value is always going to be 100. That is the amount that has to be repaid. Okay, and not change. However, at time of issuance, okay, the issuance price was 70. It wasn't 100, right? So at time 0, at issuance, both the market and the nominal value are going to be the same. They're going to be 70, right? Because you could buy the bond for 70. That's the market value. However, through time, the value, the market value is going to change. Okay? And the nominal value is going to fluctuate as well. Okay. So you can see here in the graph, when we look at 1 year after the issuance, you see that the market value is a lot higher than the nominal value. Okay. But then at maturity, all 3 values converge. Now, what has basically happened here is that the debtor is going to have one perspective on how he's going to record, his indebtedness or his liability, and the creditor has a different approach, right? So when we look at securities from the debtor perspective, we're saying here interest is equal to the amount the debtors will have to pay to their creditors over and above the repayment of the amounts advanced by the creditors. Wow. Interest accrual on a debt instrument is determined for the entire life of the conditions set at inception of the instrument. Okay? So when you're looking at it from the debtor approach, is what the debtor believes he owes to the creditor at a specific point in time. However, when we look at it from the creditor's perspective, he doesn't really care what the nominal value is. He doesn't even care what he cares about the face value, but he doesn't even care really about the nominal value. He cares what he's able to buy that bond at that specific point in time. And depending on the market conditions, that's going to influence the price. But as we said before, in financial accounts, we have to have symmetry. Financial assets must equal financial liabilities. Okay. So what are we going to do? So we have a couple of rules that we have to follow. And again, here we borrow a little bit from the accounting world. So if the instrument from the creditor's perspective is going to be held to maturity, then we don't have a problem, right? The debtor approach and the creditor approach are going to be the same. If the creditor is not going to hold the security to maturity, then what's going to happen is that on the asset side, there's going to be fluctuations in the bond price, and it's not going to be shown from the debtor side, and we have to make those equal. And what we usually do is we're going to choose the market value. Okay. So now, what that means then, it's going to be a little bit different for the debtor or the issuer of the debt versus the acquirer. So what we usually do in the financial accounts, in addition to producing, I mean, you could do all sectors, I mean, not many countries do. Usually what we do is we're basically going to present the estimates on market value and some of the key sectors, like government sector, for example, in both nominal and in terms of market prices. Okay. And this next slide here, which is was going through what is the market value for equity. And you know what we said before, when it comes to listed shares, provided that you have access to capital markets, then you should be able to get the market price of your instruments. The question that arises, or the issue that arises, is what do we do about unlisted shares where there's no trading on financial markets? Okay, and we can't really get any market prices or transactions, not readily available. So we have to use some kind of estimation techniques. And I'll just quickly go through some of these estimation techniques. And I believe John mentioned earlier that there's been a lot of good documentation that's available on the UN website. And what we've done now that we're trying to, enhance, the manual, there was a lot of guidance notes that have been prepared, for specific issues. And there's a guidance note on unlisted equity that you might want to take a look at. Okay. But just to talk a little bit about some of the approaches that have been recommended, we have basically 6, if I want to, approaches. Okay. One is called here the recent transaction price. And you can see the description of that. What is the recent transaction price? Well, as the title says, it's the most recent observed transaction price that you get in the market. And then we have a column here called remarks. Well, yes, it could be a very good indicator, or it could be a very bad indicator. So if your most recent price is from 20 years ago, it's not that good, right? So recent means that, it's very timely, and it's relevant currently. Then we have here the net asset value approach. And this one here needs, what you have to do is you have to value both the assets and the liabilities at market. Okay. So if you have or are able to revalue both your assets and your liabilities at market, if you take the difference, that difference is going to give you a market value for the unlisted equity. Because as we mentioned before, unlisted equity is basically the residual net worth left over. So if you can do that, then that's probably the very good approach. But it's very difficult to value the assets and the liabilities at market. And one of the caveats is, as you know, right now in the system of national accounts, in addition to having, fixed assets, we also have now, intellectual property products, exploration and evaluation, software, R&D, data, and we also have intangibles. And it's very difficult to get market prices for those. Okay. Then another approach, as you can see here, with the present value, or sometimes for prices to earning ratios, where again, you're going to try to get some kind of a ratio, to be able to, take the book values into market values. What some countries do is, if they're able to get both market and book value information by type of instrument, you can use that ratio to then inflate or deflate, what you need to do. And then other ones look at the market capitalization. And then the last approach here is you're just going to look at the own funds at book value. Okay. All right. So now I just want to talk a little bit about, the other changes in asset account. And then we're just going to do one quick example if I've seen, do I have enough time, or am I running out of time? I have 10 minutes. Okay, so then we won't go through the example, but maybe I'll quiz you tomorrow morning so you can tell me what the answer is. But of course you have the answer, so it's up to you. So I just want to talk about here is that this is, when we're talking about, the balance sheet and the sequence of accounts, you can see if we start now from the second column, as John mentioned before, we went from the production account all the way down, to the use, which was the savings, and then we start talking about the accumulation accounts. Okay. So the identity that we try to follow is we're going from the opening balance, then you have all your economic transactions. And then what you need to do is you have this other account called the other changes in asset account, which is going to be broken down between revaluations and other volume changes. And then when you add those four components, you get to your closing stocks. Now, what I've seen a lot of countries do is, well, two things. We'll start with the second worst thing, and then we're going to do the worst thing. Second worst thing is that you have your opening balance. You have some kind of estimation for your economic transactions. You were able to get some kind of price changes, and then that was it. There's no account for volume changes. The worst thing you can do is take the difference between the opening stocks and the closing stocks and just say, well, that's it. They're all economic transactions. Now, why are those two things not very good? Well, as you all know, when we have residual accounts, okay, any error anywhere else is going to be embodied in that residual account. Okay? So in other words, it's useless. It doesn't give us any information whatsoever. And as John was saying, revisions are not necessarily a bad thing. Okay? And discrepancies are not necessarily a bad thing. You should show the discrepancies. Yes, you might get embarrassed, but that's okay. Because the discrepancy is telling you something. And that's why it's important to try to get some kind of an estimate for all of those four things, for your opening balance, for your transactions, for your evaluations, and your volume changes. And you get your closing balance. Okay? And then when you're doing the consistency, which we'll talk about the third day, it's important to see why you have these statistical discrepancies. Are the statistical discrepancies coming from, as was mentioned, because of data sources, because of timing, because of poor judgment? Okay? Well, we'll go through those. So when you're looking at here in this identity, what I want to really emphasize is that you have to try the best you can to try to get information for all four. And the example that, you can go through at your own time, was just trying to show that, you have some limited information. The example, is easy in the sense because I already gave you some information on economic transactions. And then because you're going to have to just work out what you think should be revaluation or volume changes. Okay? But in the real world, in practice, and what you're facing, in your day-to-day, working lives, is that you don't have complete sets of information. And you're going to have to use some kind of techniques to be able to derive, flows, to be able to derive, evaluations and other volume changes. Okay? Because it's very important, because if you don't, then that's what's going to cause you all your errors. If you put everything as transactions, then that's one of the biggest reasons why your net lending borrowing from your current and capital account is not equaling to your net lending borrowing from your financial account. Because as John mentioned, on the real side, they're transactions. They don't account for revaluations or volume changes. Okay. So I'll stop here. I apologize, I couldn't go in depth in some of the more, exotic instruments. But hopefully got a little bit of an overview or a reminder of some of the things. And now I just open up the floor if there's any questions. This is just the example, and then got the solution. I won't show it to you because I know you're all honest. There we go. A question back? Please go ahead. Yeah.
Thank you very much. This is a very good presentation. You gave us answers to the questions that are reflected in our practice. But while listening to what you've been presenting, I had some questions. One question is about the financial instruments transactions. They have to be presented in the financial account, but some of the transactions have to be presented in the tables of financial intermediary. It's UFPIC that we are often heard about. There are such tables. So if we have a bank that produces some shares, for example, issues some shares, and then he does the emission of shares, then it has to be reflected at the financial account. But if this bank, for example, pays dividends, then in that case, we have to reflect it not in the transactions of financial account. We have to place it into the services of financial intermediary. So if we attract a deposit from someone, this should be reflected in the financial account. But if we pay interest on that deposit, in that case, we should not touch the transactions of the financial account, but we have to present it in another table of financial intermediary. So my question is as follows. Is there is a list of such transactions that we can be presented about? So what transactions are placed into the financial accounts, and what transactions should be placed in UFPIC or into some other changes like changes with assets? We're talking about changes with assets. There can be some force majeure situations when we are counting, for example, the balance of non-financial assets and liabilities. There can be different variants. So if you can highlight this moment for us, specify it more precisely, what should be presented in the financial account and what should not be presented in the financial account. But thank you very much. This presentation was very, very useful for us, and we start thinking and reviewing and rethinking what we are doing. Thank you very much for it.
So thank you very much for the question. It's a very good question. So yes, I mean, you have to remember, okay, well, so in the example that you gave, the bank has issued some shares, and then, subsequently had a good year and it paid dividends to its shareholders. And those dividends are going to be shown as the primary income of the shareholder, and there's going to be a corresponding, dividend payment on the bank side. However, as you know, in the financial accounts, we have the quadruple accounting. So what happens there is that for the recipient of the dividends, what did he do with the dividends? If I pay you 50 of dividends, basically what I'm doing is I'm giving you a check, I'm giving you a cash, I'm giving you something in return. So that corresponding in the financial accounts, you're going to see that as either an increase in your deposits, right? And there's going to be a corresponding decrease in the bank's deposits. So that's how you square, that transaction. So there are not really other changes in asset accounts, right? I mean, the property income is going to be shown above the line, as it should, because it's a return to capital or a return to an asset, right? And that's where it should be shown, right? But then on the financial account, what we're going to see now it's going to be either in cash, could be now another issuance of shares, etc. Right? Because the dividend, right, the dividend payment, now we have to know what form is the dividend payment going to be taking. If it's in cash, it's going to be in the shareholders' deposits. Or if it's in terms of shares, then it's going to be a transaction in shares. So there is a transaction. So maybe I misunderstood the question, but I think, in the system, we're capturing that transaction. No?
Yes, this is mostly what I was asking about. But there is another question about these tables on the services of financial intermediary. And this is measured indirectly. And this is also directly linked to the financial instruments. For example, why I've been asking about these shares if we have a share, and for example, the dividends were not paid, they were just added to the capital. And I say that these dividends, according to our policy, corporate policy, will be used for the future strategy of development. Then in this case, the assets have to grow. Like we take the sum of 50 of the dividends, then I will have plus 50 to the left side of the financial account. But if I pay the dividends, you are right, I have to know in what form they will be paid. It can be cash, it can be the bill, but if it is cash, how can you follow what is going on? We should see the growth of the cash. Or if, for example, this is a household, there should be some additional reporting that would allow us to allocate it. And the second question was about deposit. Deposits, also we pay some interest on the deposits, and these percentages that are paid, they always go not to the financial account itself, or do I understand it wrong? But it has to be sent into the table on the services of financial intermediary that are measured indirectly, and there you don't have any link to the financial account, it goes to another side. On shares, right, there can be some connection or relation, but on deposits, that would be completely different direction. So when we calculate all GDP or gross national product, then we have to do the correction. And we won't see that interest in the financial account that are linked with deposits, or are we able to see them somewhere?
Yeah, so sure. When you have to pay, when there's intermediation involved and there's an interest payment, remember, so FISM is going to take into account the service, right? But then the S&A interest is going to have to be shown, in your primary income, and then it's also going to be shown, in the financial accounts. So again, I'm not clearly understanding the question. The thing is that, a lot of things go through the cash account. Now, it's very difficult to actually make sure that each item has been recorded in that account. But, in essence, what we're saying is that if we have good information from the depository taking institutions, it should be there. Now, are you going to see it? No, probably not. Because, we're talking about, a volume, there's a huge volume of transactions that are going through the cash. But when it comes to your question, if the interest is not paid, it's going to still be shown in the primary income account as, because remember, above the line, when we talk about the net lending, net borrowing above the line, we never ever said cash was exchanged. We never said that for me to buy a pair of shoes, I had to give somebody, X amount of money. The manufacturer of shoes basically produced the shoe. I consumed the shoe. Above the line, we never talk about how it was financed. The financing happens below the line. So what did I do? I used my credit card. I reduced my cash to buy the shoes. When I reduced my cash to buy the shoes, I increased the cash of the manufacturer of the shoes. So the same thing is going to happen when it comes to interest. If interest is not, we have the FISM component, which is the service. So that component is going to be reflected in whoever is consuming that service. But the remainder is going to have to go into the financial account. Right?
Yes, you are absolutely right. The remainder will go to the financial account.
Yeah. Okay. All right.
Yeah, just perhaps to complement, because that's a very rich discussion. As Emmanuel rightly says, commonly for cash, for bank accounts, you will have aggregate information that you're collecting from the banking side. So the bank should be able to tell you how much is in household deposits. And you have to make the assumption that anything which is paid in cash, whether it is a dividend, whether it is interest, whether it is something else, will be in those changes in bank deposits, but you won't see the individual transaction. But then, as Emmanuel rightly said, sometimes you have non-financial transactions which are not settled in cash. So you sell me your car, but I promise to pay you next year. And then we have to enter into the financial accounts, this other accounts payable and receivable. If we're businesses, it would be a trade credit. If we're households, it will be other accounts, this category. That's an extremely difficult category to measure. For trade credits, you have surveys of businesses and so on, so you can try and capture that. But for the other timing changes, it becomes very difficult. And this is why commonly a lot of compilers will make adjustments to other accounts receivable and payable to reduce the vertical discrepancy, because they think that that's where the problem might be. Just to deal, though, with your question about these financial intermediation services, or we call it FISM in the English acronym. So that's a very interesting example of relating interest flows. So we have a data source for interest flows with a data source for the stocks, the total amount of deposits. And so what we're doing, and it depends who in your country is calculating this FISM thing. Commonly, it's the statistical office because it forms part of the regular national accounts. They will be taking the stocks of deposits, and they will be taking the interest flows, and they will be separating the interest flows into part, which is interest, and part, which is a service charge. So, but once again, the important thing is you're separating interest from service charge, but these are both items that go in the non-financial accounts. They just go in different places in the non-financial accounts. So you have the interest under primary income, and you have this financial service, which is production and consumption of households or businesses, of course, whoever's using the banking services. So again, it's important to say that you are splitting, but you're just splitting the non-financial transaction here between two different boxes. Yeah, very important to understand. Thanks.